The biggest global recession is about to start because of the impending collapse of China's entire economy. China's severe economic fragility is being shown by recent financial data. Although the Chinese Communist Party is making efforts to revive the economy, the truth has already been revealed. Cathie Wood, who oversees nearly 20 billion, was quick to realize the suffering that the globe was going to experience. Now, according to Economists, the US GDP growth is outperforming China's for the first time in nearly 50 years. So what is happening in China? This video will explain China's current situation and the starting evidence that indicates the nation's downfall. China's economy saw significant growth when it started to open up in 1978. China's GDP increased by 10% annually on average. Citizens of China experience major prosperity as a result. $800 million individuals or more have overcome poverty. Education was given priority, the healthcare industry made huge progress, and technical advancement was quickened. China has developed into a manufacturing powerhouse revered by all economists as a result of its unequaled growth. But as we all know, nothing comes for free. China's rising liabilities were the primary driver of its unmatched success. Those that took out loans saw their net worth increase quickly during periods of strong economic growth. This encouraged others to follow suit, which accelerated the economy's growth. More people in China started taking out loans as a result of this. The cycle provided a constructive feedback loop that led to exponential growth in the country. This technique has been effective for many years, but China's debt has reached an unsustainable level. Over many decades of prosperity, China's government debt to GDP ratio climbed to over 66%. Along with this trend, the total public debt in China has increased to almost 300% of GDP. This is about double the US non-financial corporate debt to GDP and nearly 60% higher than the global debt to GDP ratio. China's recent problems are showing that such a big number of liabilities is unsustainable. People defaulting on their loans causes the economy to slow down. President Xi has a simple goal of common prosperity and has been implementing a vast array of regulations for this campaign. Real estate is one of these industries. The height of uncommon prosperity is represented by real estate prices. The increase in real estate values has disproportionately benefited investors. By enacting new property taxes, Xi is aiming to crack down on this. The Three Red Lines policy is another measure Xi has put into place to crack down on real estate. The maximum amount of debt that real estate developers are permitted to have is capped by the Three Red Lines. Housing prices are falling at incredibly rapid rates as a result of all these strategies. The number of sales of newly constructed homes is also declining. Early May 2022 saw a 33% decline in new home sales across 23 major Chinese cities. A 33% decline in home sales would cause a 9% decline in China's GDP because real estate makes up 25% of the country's GDP. The Chinese government is taking every action at its disposal to stop the company's further collapse because it is aware of the approaching crisis. China's government has been lowering interest rates while the US Federal Reserve has been raising them to save its economy. The current prime rate for consumers and business loans in China is 3.7%. With time, it is only anticipated that this number would decrease even further. The nation just reduced its prime rate for 5-year loans by the most since 2019. The majority of investors view this disaster as a unique event that would have an impact on other nations. Contrarily, the global economy may experience a catastrophic recession as a result of China's economic collapse. In 2021, China accounted for more than 18% of the global GDP. Therefore, a sharp decline in China's economy would weaken the entire world. Add to it the fact that Europe's economic development is slowing down, and it is evident that we are in a worrying situation. For the first time in 2019, the US bond curve has inverted, which suggests that a recession may be on the horizon. Bond investors anticipate suffering a great deal. Most of the time, recessions are preceded by an inverted yield curve. China and Europe are in a difficult spot. The Feds appear to be putting themselves in danger. Right now, the world's economies are exceedingly weak, and a collapse of the US economy would send them all into an unimaginable turmoil. The most recent global recession, which affected a wide range of nations, occurred in 2008. However, the 2008 recession was not as severe as the current crisis. China's GDP continued to rise by double digits throughout the worldwide recession of 2008. Africa, Australia, and the rest of Asia didn't see their respective GDP significantly fall either. In contrast to 2008, the bulk of Asia, Europe, South Africa, Australia, and America is in distress now. Throughout this video, I've displayed a lot of graphs regarding the Chinese economy. However, those figures might not be accurate. China is infamous for providing fake economic statistics that hide financial crisis and overstate development. Many Chinese cities have admitted outright to fabricating economic data. Due to false additions, the industrial city of Baotou in northern China publicly altered its economic report. In 2016, a different city known as Chinese Manhattan inflated its revenue by 33%. This kind of inaccurate reporting may indicate that China is already experiencing a recession. We are just not yet aware of it. According to Cathie Wood, the real data in China would indicate even more dramatic decreases in sales in the real estate industry. She thinks that might ultimately result in a short-term decline in oil prices. How can investors therefore prepare their portfolios to endure this slump in light of all these information? Holding cash is one easy strategy to keep afloat, but it can reduce your money because of inflation. Considering that both Asia and Europe are struggling, investing internationally is likewise not an option. Investing in the US market is one method to safeguard your money in the upcoming months. Contrary to what might seem obvious, the US financial markets are still in the best shape when compared to other markets. The US dollar is still holding up reasonably well despite undergoing substantial inflation. The dollar index measures the dollar's strength in comparison to other countries. Despite significant inflation over the previous year, the index has been rising. Even though there may be a big decrease in inflation, investing in gold could be a great hedge. Every asset has drawbacks, is what I'm saying. Diversification among the best assets would be the best strategy in this situation to reduce volatility while maintaining favorable returns. One way to diversify is to hold 25% of your assets in cash, 5% in gold, 5% in Bitcoin, 40% in exchange-traded funds, and 25% in individual stocks. Even though such a portfolio may not produce the highest returns, it will still allow you to make long-term gains and have enough money to buy the downturn. Investing in publicly traded growth stocks could be very profitable if you're willing to take on more risk for greater returns. We are all aware of the severe decline in public growth stocks. With ARK Invest garnering the most media attention, this has created a wide range of chances to earn 10 or 20 times returns over the coming several years. Public growth stocks are incredibly volatile, so only invest if you're ready for your portfolio to trend down soon. Having said that, I have seen some billionaires change their minds about growth stocks and begin to invest. Do you believe that the US will suffer along with China? Let me know what you think about China's impending recession down below. Click the like and subscribe buttons if you enjoyed this video, and I'll see you in the next one.